Fellow traders, I'm sure we've all been here. You draw the perfect support line on your chart. Then you execute your entry as price pulls back to that support, only to watch the market continue dropping and stop you out. Before you know it, the market reverses without you, rallying all the way to your profit target. I know it's frustrating, but there is an explanation. And in today's video, I'm going to talk to you about why your support line is fuel for the market makers. Here's the reality. Retail traders, people like you and me, we use lines as barriers. We think price shouldn't go below this, but institutions, they see those lines as liquidity. To buy 100,000 shares without slipping the price, they need a seller. And guess who is forced to sell when price breaks support? You are. Your stop loss is their entry ticket. Let's look at a chart. Textbooks teach you that this equal low is a double bottom. Strong support, right? This is an algorithm. Big money uses it as a magnet because they know that a lot of retail traders' stop losses are sitting right at this area. And they are going to draw price down here like a magnet to capture those stop losses and use them as an entry. So, how do we stop getting run over? Simple. Rather than buying the touch of support, I like to wait for confirmation that price is turning around. I will move to a smaller time frame chart once price hits the support level. With my three-step confirmation process of a higher low followed by a break above the higher lows candle body, that is my entry to then be on the right side with big money. Now, context is king when buying a dip. You see, I want to know that on the higher time frame charts like this daily chart for the S&P 500 is in an uptrend. That is when I am looking to buy a dip back to support. Going down to a smaller time frame chart and watching, looking for that evidence of a liquidity grab by market makers. Price pulling back into the support level, running stops from retail traders, and then looking for a big bottoming wick on a smaller time frame candle. That big bottoming wick, like we will see on this 30-minute candle right here, that is money moving back into the stock and price following shortly thereafter. This is the move that I want to be a part of. That's the transfer of wealth from the impatient to the patient. Stop trying to front run institutions. Let them reveal their hand first. Treat obvious levels as liquidity pools. A line is not just a line, it is a zone. Wait for the stop hunt to complete. Obvious levels are liquidity for market makers. Then enter as you get the confirmation. If you want to trade with confidence and control, you need to stop being the liquidity for the market makers. And if you found this video helpful, I do live trading every day in the Trendy Trading Room at Simpler Trading with my trading partner, Trendy John, where we talk and teach about supply and demand, these buy zones and sell zones, and how to trade them with consistency and discipline. I hope you'll join me in the live trading room. I'll see you in the next video.